Good evening to everyone. My name is Irene Lutz Sirudianathan. Today, I and my team members want to present the project answers for the introduction part. Sophia Greek is the managing director of the Trade Kushi company. Currently, she has sent an email to finance officer for various issues. The first issue stated by managing director in the email is to propose the budget. The proposed budget are quantitative plans for the future. The budget is an important tool for manager control. The inaccurate or unreasonable assumptions can quickly make a budget unrealistic, and budget can lead to inflexibility in decision making. So since the managing director went for a meeting with the senior management team, the solution to prevent the various issues is to review the budget. Meet with the senior management team to review the budget will be highlight the possible constraint issues and any limitations caused by the funding problems. And the first question for the how to explain the importance of cost volume profit analysis. For the first question, okay, the importance of cost volume profit analysis is to provide an insight into the effects and interrelationships of factors which influence the profits of the firm. The relationship between cost, volume, and profit makes up the profit structure of an enterprise. The cost volume profit relationship become essential for budgeting and profit planning. It had to determine the maximum sales volume to avoid losses and the sales volume at which the profit goal of the firm will be achieved. As an as an ultimate as an ultimate of objective, it helps management to find the most profitable combinations of cost and volume. Therefore, uses cost volume profit analysis to predict and evaluate the implications of short-run decisions about the fixed cost, marginal cost, sales volume, and selling price for its profit plans on the continuous basis. The cost volume profit analysis, also commonly known as a break-even analysis, look to determine the break-even points for different sales, volume, and cost structures, which can be useful for managers making short-term business decisions. That's all from me. I would like to pass to my team member.
Right, next is for the break-even point. This is for multi-product break-even points. So the first step, we want to find for the unit contribution margin and for the percentage of the total margin. The second step, we will calculate for the weighted contribution margin as stated in the table. So the 22.9 we will times with the 70.3%, and for the performance we will calculate 41.19 times with 29.7%. Right, the third step we'll calculate for the break-even point, which is fixed expenses divided by weighted average unit contribution margin. So the answer that we get is 281,582 for the combined units, for the combined product. And the fourth step is for calculate the individual sales, which is for casual. As we calculate, we will get 197 and 952. For the performance, we get 83,629.85. And for the break-even point in value, for the casual, we got 16,825,932. And for the performance, we got 10,035,582. Next, I will pass to the team members.
So for this part, we are calculating the total cost of sale for each shoes, which is wool is 15,683,360, and for wood it's 8,296,680, and for hill is 4,346,000. And lastly, if flat 7,309,720. So we compare the all volume of sale to get the gross profit margin, which is wool 54%, wood 50%, hill 56%, and flat is 59%. And we increase the gross profit margin to 70%, and we get the volume of pair sold for wool is 529,412, wood 329,412, hill 120,833, and flat is 204,167. So next question is about new break-even point. We are using format and formula, and then we get the break-even point is 130,049. Next part I will pass to Shukri.
Okay, thank you. So for the fifth questions, there are three major steps in the control phase of budgeting. The first one is record and compare the actual budgets, the actual result to budget figures. All companies must have some form of accounting systems. It is important for the companies to understand the financial information available. By measuring actual result against budget, it will give insight and help management to monitor performance. By using this case, we are using static budgets. So the next is performance, variance calculations, and analysis. After both actual and budgeted figures have been recorded, the difference between them can be seen, and it is called variance. This variance will be analyzed to find the cause of it. Based on the case study, by using a static budget, you can see there are two variances which are favorable and unfavorable. The cost of sale is having a favorable variance value, which means the actual cost is less than the expected cost. This is good for the company because they have managed the cost effectively and efficiently. On the other hand, sales revenue and profit are having an unfavorable variance because the actual income and profit is less than the expected income and profit. This will alert the management to improve some aspects to ensure it will perform better in the future. The third one is corrective actions and feedbacks to manager. After all the data has been analyzed, it is important to take some correction measures and equip the managers with the gained insights. This will help to improve department efficiency and effectiveness. For track sheet case, the sales department, marketing, and also logistics can collaborate to improve the income. This will ensure the company have more income and profit, which will surpass much more than margin of safety. The second budget also can be revised to expect less, but at the same time, they need to manage to sustain the profit.
For the production budget, the number of the sales units for each product is obtained from the budgeted sales, and the desired ending inventory is calculated by multiplying the budgeted sales units for each product to be 15%. The beginning inventory for each product is calculated by multiplying sales volume each product with the gross profit margin have been given, right?
So in conclusion, both budget and CVP analysis are very important tools for decision makers to make economic decisions. By having knowledge to know about the company positions, managers can manage the productions and resource effectively, and this will give the company a better performance and good profitability. Thank you. That's all from us.